So, like we talked before, if something is broke, you use tools to fix it. And the same is true with the economy. When something's not working right, the Fed uses their tools to try and fix the problem. So, we have their four tools here. And like I said, we're going to go through them and see what exactly they are. So, the first one we're going to start with is called the reserve requirement. So, prior to the founding of the Federal Reserve, there weren't a ton of regulations on banks. And so when the Federal Reserve was created, one of the things they did is set a reserve requirement that tells banks when people deposit money into the bank, this is the percentage you have to keep on hand as cash, and the rest is available to be loaned out. So the reserve requirement is the percentage of each deposit the banks have to keep on hand. Okay, so if you deposit $100 into the bank, they don't actually keep all of that money in your system, in your account as cash. They only keep a portion of it, and the rest of it gets pooled together with everybody else that's depositing money. And then every time you swipe your card or people take out loans, it comes from that pool of money. Okay, so the reason for this is that if people in mass ran to the bank and everybody tried to withdraw cash, this allows the banks to have that cash on hand if they see a large amount of people doing that. Okay, so prior to this, we saw a lot of bank runs happening in the United States where one person would go withdraw their money. Other people see it happening, they withdraw their money, and pretty soon there's a panic and everybody's running to the bank to take all their money out. Well, the bank, not having kept much money on hand, isn't able to give people their money back. And then you're just out of luck. The bank doesn't have money, you don't get it. Okay, so we create the reserve requirement to put a little bit more security into the banks, a little bit more confidence into the banks for consumers. And then the government also passed something called the FDIC, which insures your money. So if there's a bank run and there's not cash to cover you, the government makes sure you get your money back up until a certain amount. So between the two, it does help to put a little bit more confidence into the banks here. Now, if you have a bank that is doing millions of dollars of transactions every day versus a bank that's doing only maybe a couple $100,000, the reserve requirement is going to be different for them. Okay, if you have a large bank, you need the bank to keep a larger amount of money on hand in case there's a lot of withdrawals, versus a smaller bank has to keep a smaller amount on hand. So it is the Fed that sets the reserve requirement that tells banks this is how much money you have to keep. If they increase it, banks have to keep more money, and now there's less cash flowing through the system. If they lower the reserve requirement, banks have to keep less money, and now there's more money available to loan out. So at the end of the day, banks track this and see where they are with their reserve requirement. If they have more than the requirement, then no big deal. They have more cash on hand than they need. But if they notice they're below the reserve requirement, then they need to get cash from somewhere to make up for that. So this is where the next two tools come into play. Banks would have to borrow money either, from another bank or from the Federal Reserve Bank. So where they go determines which of the rates we're talking about. So if banks borrow from each other, and they say, okay, Bippus State Bank, we're $5,000 below reserve requirement. They call up PNC and say, hey, we need this cash. Do you have it? And PNC says yes. Banks don't just give out money, right? They charge interest rates. And so the federal funds rate is the interest rate charged when banks borrow from each other. Okay, now this interest rate is determined by the Fed. So they tell banks the federal funds rate is 2%. So the banks charge each other 2% to borrow. Okay, so BIPIS gets the $5,000. They have to pay that back plus 2% interest for what they borrowed. And then PNC is able to make some money off of lending that money out. All right. So it does tend to be a little bit easier for banks, to borrow from each other, since they're right down the road or the next town over than it is to drive to your Federal Reserve Bank to borrow the money. But they have that option. The other option they have is the discount rate. So this is the interest rate charged when banks borrow from the Federal Reserve Bank in their region. Okay, so if Bippus State Bank goes to Chicago Fed to borrow the $5,000, the interest that they pay is the discount rate. Okay, so when you're reading, you're talking about the discount window, that's what this is referring to. Okay, so it the rates are not the same. They are different. So banks can use that to determine who they're borrowing from, right? If it's the discount rate is cheaper, they're going to borrow from the Fed before they borrow from other banks. Unless it's a real emergency, then they're going to pay the higher rate to get the cash they need. Okay. But those are two options that banks have. The fourth tool available to the Fed is the open market operations. So this is the kind of go-to tool for the Fed because it allows them to enact monetary policy without changing a lot within the banking system. So, open market operations refers to the Fed buying or selling securities to banks. So, security is another word for bonds. We talked about that back when we talked about investing. So, for example, if you buy a bond from the government gets your money, you get the bond, they pay you interest. At the end of the time, you give the bond back, they give you your money back. Same thing works between banks. So if the Fed wanted to buy bonds, they would buy it from BIPIS. So now BIPIS has the cash, and then they would pay interest to the Fed, and then the Fed would give the bond back after so many years. The Fed would get their cash back, and then it would restart. Okay, so this is a really quick way for the Fed to get cash into or out of the system. Okay, if they wanted to slow down the system, they would sell bonds, right? Because if the bank buys it, now the Fed has all the cash. So they've taken money out of the system without actually destroying it. And if they needed to speed up the system, they would sell bonds. So now the banks, or they would buy bonds, sorry. The banks would get the money and the Fed would get the bonds. And now there's more cash in the system. So this is the go-to because it doesn't require banks to change any of their policies or any of the ways that they're operating. It's a way to just easily get cash in and out of the system here. Now, all of this is great and it tells us what the Fed can do to try and fix issues. But we're thinking, okay, as an individual, none of this applies to me. And that is true. The interest rate that we as individuals get charged for borrowing is not set by the Fed. However, anytime these rates are changed, it is going to lead to the banks changing their own interest rates for the loans that they are offering. Okay, so it will have an impact on your life. A lot of you are going to college and you're going to need to take out loans for that. If the, let's say, if discount rate and federal funds rate both increase, that makes it more difficult for banks to get money. So they're going to be less willing to borrow out borrow out money, and they're going to raise their own interest rates, which now makes it harder for you to get a school loan, or you're going to get less money in your loan, or you're going to have to pay a lot more because it has the higher interest rate than what you were before. Okay. If they were to lower these rates, then banks tend to lower their own interest rates. That makes it easier for businesses and individuals to get loans, and so that's able to speed up the economy. Okay, so it does have a very strong impact on us as individuals, even though the rates are not actually set by the government. Okay, so these are the monetary tools. Go ahead and go back to the agenda and see what your next task is. And in the next lesson, we will talk about the fiscal policy tools that the government has available to them.